Trading Forex without a clear strategy can feel exactly like trying to read a map in the middle of a hurricane. Prices fluctuate by the second, and the noise makes it nearly impossible to tell where a trend is actually heading. The Commodity Channel Index, or CCI, is a specific mathematical solution to this problem. Developed in 1980, it's a momentum-based oscillator that calculates the current price level relative to its historical average to filter out market noise. This guide will show you how to build a filtered, high-probability trading strategy on your own screen by layering this indicator with structural market data. To execute this strategy today, you will need a charting platform, a demo account for testing, and a clean 4-hour Forex chart. Establishing this technical framework transforms the process of reading price action from an emotional reaction into a structured data analysis. To begin, open your Indicators menu, search for the Commodity Channel Index, and apply it to your active chart. Most platforms default the CCI to a 14-period setting. This short time frame makes the indicator highly sensitive, which often creates excessive noise and false signals for swing traders. Open the Indicator Settings panel and change the period length from 14 to a longer time frame, such as 30 or 40. Increasing the period results in a smoother line, ignoring minor fluctuations to focus on major moves. Note the horizontal levels at plus 100 and minus 100. Readings above plus 100 suggest overextended upside, while below minus 100 indicates oversold conditions. Adjusting this sensitivity is your first defense against reacting to meaningless micro-fluctuations that don't represent a real shift in momentum. Even a smoothed CCI is vulnerable to whipsaws, false signals that occur when the market is moving sideways. To prevent these losses, we will use a 200-period moving average as a mandatory trend filter. Add this moving average over your price candles as a clear boundary. The rule is binary. Only look for long entries when price is above the line and shorts when price is below it. If the CCI gives you a buy signal, but the price is still trading below the 200-period moving average, the trend is not in your favor, and the setup should be ignored. Layering a macro trend filter over a momentum oscillator moves your execution away from instinct and toward a plan based on statistical alignment. Look at the center of the CCI panel to find the zero line. This represents the point where the current price matches its moving average. When the indicator crosses from negative territory back above zero, it signals that bullish momentum is reclaiming control of the average price. You can find higher probability entries by looking for divergence, moments where the direction of price and the direction of the CCI disagree. Bullish divergence occurs when price hits a new low, but the CCI prints a higher low, showing downward momentum fading. Confirm this setup by drawing historical support zones. The ideal entry happens when price tests this support, confirms divergence, and bounces upward. Combining mathematical divergence with structural market support suggests that selling pressure is losing its grip, providing a defensible entry point. This is the complete three-part system: a macro trend filter, horizontal support zones, and a smoothed momentum oscillator. This layered framework provides a level of clarity that is impossible to achieve by looking at raw price action alone. Open your charting software now, pull up a 4-hour trend frame, and look back through the history of a major pair to find where these three elements aligned. No indicator can guarantee a specific outcome. Always test this strategy on a demo account and use strict risk management before trading with live capital. Long-term success in Forex relies on the disciplined, repetitive execution of this filtered setup over a large sample of